My topic today is the ongoing subprime and credit crisis. Since our meeting today will also cover for the first time prospects for the Indian economy, I thought I should motivate my presentation with the following proverb from Mahatma Gandhi. Whatever you do will be insignificant, but it is very important that you do it. I plan to divide my remarks into three parts. First, I want to recap briefly what has happened in the crisis since it erupted in August of last year. Second, I want to comment briefly on the strategy for managing the crisis. And third, I want to offer a 10-part reform program for preventing and managing future crises. Needless to say, this will require that I talk fast. With subprime mortgages representing only about 14% of the stock of U.S. mortgages, most observers expected rising delinquencies in this segment to be contained at moderate cost. Testifying in July of last year, Fed Chairman Bernanke estimated that credit losses associated with subprime mortgages would probably total $50 to $100 billion. As we now know, what began as a subprime crisis has proved to be wider, deeper, and more damaging than originally thought. Consider the following snapshot of actual and prospective credit losses: liquidity and credit spreads, recapitalization of financial firms, liquidity injections by central banks, and U.S. home foreclosures. By now, we are up to over $200 billion in credit losses worldwide just to subprime exposure. A ballpark estimate is that U.S. banks, broker-dealers, hedge funds, and government-sponsored enterprises will wind up with at least $300 billion of credit losses on mortgage securities of all kinds. If you go beyond mortgages to also include credit card, auto and student loans, commercial real estate, corporate loans, leveraged loans, bond defaults, and if you add in insurance and finance companies, mutual and pension funds, and foreign financial institutions, the estimated credit losses rise to the range of, say, $600 billion to over $1 trillion. Some analysts have gone further by translating the estimated credit losses at leveraged U.S. financial institutions into estimated declines in their lending and in turn into estimated declines in U.S. economic growth. For example, one widely cited study by Greenlaw and others estimates that at $200 billion of credit losses at leveraged U.S. financial institutions results in a decline of 125 basis points in U.S. economic growth. Some other analysts, including macroeconomic advisors, are more sanguine about the real economic effects of the crisis, since financial turbulence and a tightening of lending standards notwithstanding, they don't yet see evidence of a credit crunch for healthy, non-financial U.S. firms. A second characteristic of the crisis involves the behavior of liquidity and credit spreads. Whether you look at the difference between yields on U.S. Treasuries and LIBOR, or spreads on jumbo mortgages, or on agency securities, or on municipal bonds, or indices of yield on asset-backed securities, or credit default spreads, or issuance of commercial paper, and you look at the same things in the Eurozone and the UK market, what you see is that over the past 7 to 8 months, these indicators of liquidity and credit risk have been very volatile and have at times been much higher than anything we've seen over the past decade. Similarly, you've seen a massive flight to quality with yields on 3-month U.S. Treasuries at one point going lower than witnessed at any time during the past 50 years. Just to round out the sketch of what's happened, I add the following. Large financial firms and distressed have received something like $70 billion in recapitalization funds from sovereign wealth funds. So far, there have been very few bank failures, 5 according to the FDIC since February 07, but apparently 75 more institutions are on the problem list. One of the reasons why the crisis hasn't been more damaging is that most banks, especially the large ones, went into the crisis with high bank capital. A third feature of the ongoing crisis follows from the preceding one. Faced with clear evidence that various parts of the financial markets were not functioning normally and were suffering from shortages of liquidity, central banks in the U.S., the Eurozone, the UK, and elsewhere have engaged in unprecedentedly large injections of liquidity, sometimes in a coordinated way. In the U.S. case, the Fed has progressively increased the duration of its liquidity assistance, has expanded the range of collateral it will accept, and has broadened the range of counterparties eligible for that assistance. In its most significant departure to date, The Fed announced on March 16th a new lending facility called the Primary Dealer Credit Facility that allows primary dealers access to fund liquidity at a discount window rate against a broad range of investment-grade debt, including market-backed and asset-backed securities. On home foreclosures, the rate has risen sharply, especially for subprime borrowers with adjustable rate mortgages. Many analysts expect foreclosures to hit about 2 million this year, way up from the annual rate in 2001 to 2005. It has been estimated that if U.S. housing prices fall by an additional 15% or so, or approximately a third of U.S. homeowners with mortgages will have negative equity in their homes. This negative equity issue is also raising the question of whether willingness to pay will have to be addressed along with ability to pay. Last but not least, one place where contagion from the crisis has so far been less marked than expected is emerging markets, which Arvind will talk about more. While the emerging market global bond spread is up about 150 basis points from its pre-crisis level, this is much less than seen in some earlier crises. So too with emerging market equities. Let me move next to the apparent crisis management strategy. It has 5 elements, 4 of which have been nicely outlined in the recent speech by Fed President Geithner. First element, macroeconomic stimulus. We've had 300 basis points of Fed funds reduction, $160 billion fiscal package. Aim to cushion the real economy and keep it from feeding back negatively on the financial sector. Second element, large-scale liquidity injections I mentioned, aim to minimize panic selling and contagion and to keep liquidity problems from exacerbating solvency problems. Element number 3, repairing the financial system by attracting capital injections into weak institutions and by increasing transparency and disclosure. Aim to prevent a contraction of balance sheets at financial institutions and to reduce uncertainties about who is and who is not creditworthy. Element number 4, targeted assistance to the housing sector. Aim to reduce the size and scope of the foreclosure problem and in so doing reduce downward pressure on housing prices. Fifth element, more recent, beginning of regulatory forbearance, reduce capital requirements for Fannie and Freddie, increase lending operations to the Federal Home Loan Banks. Aim to provide liquidity and support to the weak mortgage market. I appreciate the reasons for regulatory forbearance at Fannie and Freddie, but we should recognize it for what it is. In this connection, I am reminded the story of the man selling pencils on the street. Potential buyer comes up, looks at the pencils, says, yeah, these look like very well-made pencils. How much do you charge for them? Says, 10 cents each. So, well, that's a good price. Seller says, you're not kidding, since they cost me 20 cents a piece to make. He says, well, if you're selling them for 10, but they cost 20, how do you make a profit? And the seller says, volume. Well, that's what the Fannie and Freddie deal is, volume. Some argue that the U.S. authorities are now running out of crisis management bullets. I would say not yet, at least if you believe Secretary Paulson's claim that he will do, quote, whatever it takes to maintain financial stability. What could they still do? Well, they could reduce the Fed funds rate and the discount rate further and faster. They could persuade the U.S. Congress to enact a second fiscal stimulus package. They could expand further the scale, duration, collateral, and list of counterparties for liquidity assistance. They could encourage more shotgun weddings between strong and weak financial institutions. They could encourage distressed institutions to reduce dividends and raise more capital from the board. They could reduce regulatory capital requirements for banks and securities houses. They could temporarily suspend fair value accounting. They could make wholesale purchases of mortgage-backed securities and try to set a floor on the price of those assets. They could provide much larger fund assistance, federal assistance to troubled homeowners, and they could nationalize a few large but weak financial institutions a la Northern Rock. Clearly, a lot of those crisis responses would be unpalatable, and some are not likely unless things get much worse. Many of them, of course, also have limits on their effectiveness. For example, while the Fed can control short-term policy interest rates, they don't control risk premia or interest rates on long-term rates. With high commodity prices, non-trivial inflation risk, and turbulence in financial markets, long-term interest rates, including mortgage rates, have come down much less than short-term rates. As the Fed reduces short-term rates and index signals its willingness to do more, the U.S. dollar falls further and risks getting into a disorderly decline. The mantra that a strong U.S. dollar is in the U.S. national interest is becoming less and less comforting to U.S. trading partners as the euro and the yen hit highs. Yes, the U.S. and the G7 could undertake coordinated intervention to slow the decline in the dollar, but it's hard to see that having much other than a very short-term effect as long as the EU and Japan don't want to lower interest rates, and even more so long as the U.S. can't raise them. The other crisis management tools are also constrained. Okay, enough about fighting this crisis. What can and should be done on crisis prevention and management for the future? In recent weeks, the official sector has begun to provide its answer. From this past Monday's U.S. Treasury Blueprint for an overhaul of the regulatory structure, 220 pages or so. I read it, but it was difficult. To the initial reports of the President's Working Group, to the financial stability reform, to the senior bank supervisors. Parts of those reports, I think, are thoughtful and helpful, especially as regards the rationalization of the U.S. regulatory structure, efforts to get less scrupulous U.S. Mortgage lenders out of business, and getting separate credit ratings for structured products. That said, if you look at these reports as a group, they are a disappointing response to a major regulatory failure. They're too timid, they give too little attention to several key vulnerabilities revealed in the crisis, they rely too heavily on self-regulation by the financial services industry, and they lean too much on principles and not enough on specific benchmarks or rules. Since it takes a proposal to beat a proposal, let me offer my own top 10 list. I'll only be able to describe the first few in some detail. Reform number one, we need a prompt corrective action and orderly closure rule for large investment banks along the lines of what we have for banks in FDICIA, that is the Federal Deposit Insurance Corporation Improvement Act of 1991. The assumption used to be that failure of a large bank would be much more costly for the economy than failure of a large non-bank. But that assumption has become less and less defensible. Non-banks now provide a larger share of financial intermediation in the U.S. than banks. Large non-banks are big players in the derivative markets. Like large banks, large and entangled non-banks are now special, even if they don't have deposit insurance. They still benefit from the safety net and hence face a lower cost of funding than those with no such access. The U.S. authorities have also shown that they will almost certainly not put a troubled, large and entangled investment bank into corporate bankruptcy. Without a fiducia-like framework for large investment banks, U.S. authorities will find themselves in a tough situation. They will intervene only very late in the day when collapse is imminent, and then they will have two unpleasant options. Option A, put the investment bank into Chapter 11 bankruptcy and accept the potential chaos and contagion that is likely to go with it. Or B, provide large-scale public assistance to take over the bank on terms unlikely to be most favorable to U.S. taxpayers. Think what would have happened in the Bear Stearns case if J.P. Morgan Chase was unable or willing to step in and do essentially a purchase and assumption. Recall that under fiducia, there are capital-based triggers for corrective action. The bank is closed when it still has positive net worth. The shareholders are wiped out. Management has changed. And when fiducia becomes the receiver, they have options to set up a temporary bridge bank to pay off depositors and creditors and sell the assets in an orderly manner. So as long as they resolve the bank at least cost to the deposit insurance fund, the regulators have quite wide latitude in how they manage the process to maintain financial stability. This is not the case with regular corporate bankruptcy, as the UK found out in the Northern Rock case. The Treasury plan chooses to see Bear Stearns as a one-off event and doesn't offer an orderly closure rule for non-banks. Large investment banks need to be under supervision of the prudential regulator in the Treasury's blueprint, not under the business conduct and consumer protection regulator. Reform number two, we need an international agreement on liquidity standards for banks and large investment banks. Much of this crisis has been about liquidity. If you look over the past several decades, you see that large banks in some G7 countries have reduced significantly the share of narrow liquid assets like treasuries in their total assets. This trend has been exacerbated recently by off-balance sheet vehicles that get their liquidity on the liability side by very short-term borrowing. and brokers and dealers in the U.S. have long relied much more heavily than banks on repos and short-term borrowing for their funding. So what we increasingly have is just-in-time borrowed liquidity for major players instead of an adequate reserve of owned liquidity. This is okay in normal times. It's not good in a crisis, when credit lines dry up and when even collateralized borrowing may be in short supply, and when market prices nosedive for what were formerly regarded as liquid assets. This problem will not be solved by calls for more stress tests and scenarios or new principles of liquidity management. You need a definition of regulatory liquidity and a quantitative benchmark for it. I have some ideas on how such a standard could be designed so that the commercial banks and investment banks don't draw unduly on the fund for support, and so that there is a pooling arrangement similar in some ways to what we have at the IMF. We should seek an international agreement on liquidity standards, but until we get it, we should impose our own national standard. Reform number 3, Basel II will need to be reworked thoroughly, not just tweaked at the margin. Two of the two features of Basel II are that banks can use their own internal models to calculate capital requirements under Pillar 1, and that credit ratings also serve as risk weights in regulatory capital calculations. Also, the internal models generally generate lower capital requirements for U.S. banks. Suffice to say that all these elements have had their credibility severely damaged by the events of the past 8 months. Were UBS and Citigroup using these internal models to guide their asset allocation decisions, including subprime exposure, and were banks using the credit ratings on CDOs to make such portfolio decisions? If anything, the crisis shows we need higher capital requirements, not lower ones. One of the reasons why such proposals for higher liquidity and capital are not so popular with the industry is that they would limit leverage, asset growth, and probably the average profit rate. But they would also reduce the risk of crisis and what you and I pay for it. For time reasons, let me just close with the remaining members of my top 10 list. Reform number 4, reduce conflict of interest at credit rating agencies by separating the rating and consulting business, like we did with the accounting industry after Enron. Reform number 5, improve coordinating and action between monetary authorities and regulators during the buildup of asset price bubbles so that both of them don't simultaneously say, identifying and pricking asset price bubbles is not my job. If one doesn't act, the other must. Reform number 6, make Wall Street compensation an integral part of risk management by imposing a capital charge on firms that don't implement sensible deferred compensation plans. Reform number 7, tilt the growth of derivative markets toward organized exchanges where systemic safeguards are stronger and away from the OTC market. In the wake of CDO and CDO squared, why the U.S. Treasury would want to make it easier to issue complex securities escapes me. Reform number 8, improve incentives in the originate and distribute model by requiring originators to have skin in the game and by reducing the capital bias in favor of off-balance sheet items. Reform number 9, rationalize the U.S. regulatory structure using the objective-based model in the U.S. Treasury plan. And reform number 10, use some version, probably a smaller one, of the Dodd-Frank bill and a recovery lease program to reduce U.S. home foreclosures. In closing, the U.S. subprime and credit crisis has multiple causes, but large-scale regulatory failure is surely one of them. It requires a comprehensive response. Light-touch financial regulation does not increase U.S. competitiveness or U.S. leadership when it contributes to a costly financial crisis like the ongoing one. Thank you.